All right, here's the title: Modern Money, Financial Regulation, and Corporate Power. Moderating by me, apparently. Having, of course, the esteemed Lee Sheppard and Bill Black come to speak to us. I do feel the necessity to say that this panel was a little more full a couple weeks ago, but we, for an unfortunate instance, were both Jami Majood from Sarah Lawrence and also Mona Ali from SUNY Unicolts, who unfortunately broke her foot 2 weeks ago and is unfortunately not able to join us and talk about balance of payments and corporate taxation, which I was really looking forward to hearing her particular perspective. But the advantage of that is we have two speakers who can really, engage an audience for half an hour each on their own. And if we can have or something like that. Or so, yes, it's up to me to stop them rather than poke them to say a little more. Yes. And then we can have a little bit longer time to have more of a discussion about what they talked about and have more of a Q&A than the last panel where there was maybe 6 minutes for questions. So there's disadvantages and advantages, but I dare not to say benefits and costs. I think that our original plan was to start with Lee Sheppard from Tax Analyst, who's been writing tax notes for a long time, and running circles around other people on the details of taxes. And as much as MMTers and neo-chartalists talk about taxes, we have nothing on Lee. So I'm going to pass it over to China.
Okay, so how do I move the slides when I need to move them?
You should be using the clicker. The clicker in your hand.
Yeah. There's arrows on the right hand side.
On the right hand side. This thing right here. Yeah. Okay. Yes, but then this is the laser pointer.
That's the base.
Oh, okay. Which is the laser pointer? This is the laser pointer. Okay, so I'm going to get a little. Usually, when I do the longer version of this talk, we talk about military spending for half an hour. Yeah, that would be good. That might cool it off.
You can also use the microphone.
Oh,
I get.
Hello?
No. It's for the recording.
Oh, you mean it isn't on?
It doesn't amp for the room.
It doesn't amp for the room. I like to have a prop anyway. Okay, so I'm gonna start with my conclusion. I'm gonna talk tax for a while. Then Bill's gonna talk banking for a while. Then I'm gonna talk banking for a while because those are the things we know about. So I don't think that what we know about how money works is going to help us regulate companies and big banks any better. I mean, knowing what we know is valuable for discussing fiscal policy and monetary policy, but it's almost like what we have here is kind of a double-edged sword, because if the company's got wind of it, they just ask for more, and that's sort of where I'm going here. But we have to start with we're going to start with the military lecture and move into tax. So we're having audience participation here, and what is that right there? Come on, my other audience has got that correct. It's a little inlet of water there. What's it called? Strait of Hormuz. Okay. What's the significance of that?
Iran is on one side, and if they wanted to, they could shut it really easily.
Why is it significant body of water?
Because it's most of the Saudi Arabia's oil supply most or all goes through the Strait of Hormuz to the market.
Yes. Okay. And what's this right here? What's in this Indian Ocean right here? The Fifth Fleet. The Fifth Fleet. The U.S. Fifth Fleet. Okay. The dollar. is the world's reserve currency. And because it's the petrodollar and because it's linked to oil. It's linked to oil because of a deal we made with the Saudis in 1974, which is a year before the king who made the deal got killed, actually. And I think of the miraculous effects that we ascribe to modern monetary theory as really being a function of having the reserve currency. Because basically, except for right over here where this party here and this party here are trading the oil that's from here in the currency of this party here, everyone trades oil in dollars. And they have to get dollars to get oil. We have unlimited dollar swap lines with Europe. So Europe can buy oil that comes from Libya right there. Because Libyan oil is really nice oil and it doesn't need to be refined. So when you have the reserve currency, you really, really don't have to tax yourself a lot. And you really, well, we don't tax ourselves a lot. We tax ourselves about 20% of GDP. We have taxed ourselves about 20% of GDP ever since we became the reserve currency after World War I, when sterling was no longer the reserve currency. And the theory that we're all talking about here holds that your only constraints are real resource constraints. Well, we have real resource constraints, I would say, in the form of our crazy military spending. Because, we've all been talking about how deficits don't matter, right? Well, deficits aren't even measured properly. The deficit is measured by the on-budget stuff. There's a whole load of military stuff that's off budget, but the military stuff that's on budget is enormous. We have, you have the 7th Fleet over here. You have the 6th Fleet over here. This right over here, this is where that commercial boat rammed the warship the other day. That military spending is also, it's guns and butter, which is a phrase nobody has used since the Vietnam War. It is I'm not supposed to say crowding out around here, but I think it's a real resource constraint on other spending. I think we're dumping way more real resources in it than we need to be, but there is also a chicken and egg problem because we have hundreds and hundreds, some unacknowledged, of bases around the world for the purpose of maintaining U.S. notions of international order, but also for the purpose of maintaining trading oil in the dollar. Now, let's see. Okay, which one gets me the next one here? I can see you're all thrilled by that. No, I don't want that. Come on, where's my... There we go, what's that? Fort Knox. Isn't it charming? That's the proof that FDR was a complete genius. Because what's in Fort Knox? Anything? A couple of bricks with gold paint on them? I mean, Fort Knox was built in the 30s when we were on the gold standard formally, but we wafted in and out of it. Whenever we had to spend something or whenever we had to have a war, we would sort of waft off of it. And this was to inspire confidence in the currency. Here's the gold. It's in this little place here. Isn't that just so cute? But Franklin Delano Roosevelt was a total political genius. I mean, he had people in World War II when we came up with the notion of gross domestic product so we could measure how much, and that's what we do with taxes too. We measure things. We could measure how much of the gross domestic product was being spent in the war effort, right? People were asked to bring their car bumpers to places to be donated to the war effort. Now, did the war effort need car bumpers? Come on, folks. No, of course not. It was complete. It was a fiction. What? It was theater. Yes, it was theater designed to get people to think that they were participating in the war effort, because the war effort really was not that much of a strain on our gross domestic product. And that is also, well, I'm not on the map anymore. That's also because we're so big. You know, the whole overlay of a lot of our complex systems, like our medical delivery system and our tax system and our financial system, all of those would kill a smaller country. But we're so big, we can absorb a lot of that stuff. Franklin Delano Roosevelt also started the Social Security system, right? And it has a dedicated tax, right? And everybody in this room knows that that dedicated tax is a complete nonsense, right? The tax does not fund your Social Security benefits. If we go outside of this conference, if we go down to the coffee stand, if we interview a student on the sidewalk, what will they say about that tax?
It's necessary.
It's totally necessary to fund the benefits. Oh my God, and we're going bankrupt in our own currency. Oh my God, right? They'll say that, and they'll mean it because they've had it pounded into them, right? And what was my next thought about the Social Security tax? The Social Security, we also have highway trust fund taxes. We have all kinds of little taxes that are supposedly dedicated that are not. And we know that those are fictions and that they are theater. But where I'm going with this also is that the income tax is that too. And so let's start with, you know, what do we know about taxes from a central banker at around the time of FDR, who the central bankers discovered? It's like, wow, you mean we have the reserve currency and we can just create money? And we have very little constraints. And they were the ones who came up with the notion that, well, you kind of have to tax around 20% of GDP to redeem the currency. And that's what we've been doing ever since, even though that we are, by world standards, a very lightly taxed developed country, and that is part of the exorbitant privilege of having the reserve currency. But besides, you know, tax having a purpose of redeeming the currency, because, you know, we have enormous companies who pay very little tax anywhere in the world, including the United States, that are very happy to hold the currency. As a matter of fact, they're very happy to hold all their cash in the United States in dollars, even though they don't really need to. Taxes, Beardsley Rumel told us, they price government benefits and subsidies. They are kind of behavioral devices because they reward behaviors that are regarded as desirable. You're supposed to go get married and buy a house, things like that. They punish behaviors that are undesirable, like you shouldn't smoke. And, you know, he said they redistribute. They can be used for redistribution. We don't redistribute through the tax system. We have a progressive income tax, but taken on the whole, our tax and spending system doesn't redistribute downward. It's also, you know, sort of a common notion that taxes are coercive. Ours are not that coercive. The only real coercion we have, and I didn't bring the pie chart, we collect 90% of all taxes that we collect through wage withholding. So that's income taxes, Social Security taxes, Medicare taxes, what have you. The rest of them, that's our voluntary system, the other 10%, and we fight about that. I mean, that's what people like me do. We're in there while our corporations and rich people are fighting about that with the government. You know, that's the part that gets argued about. The wage withholding does not get really argued about. And we don't, if you cheat your taxes in the federal system, you don't go to jail for very long. There is Justin. I'm so happy to see you here because we're going to get to what nonsense the taxation is. And I've already told him we have a lot of unmeasured military spending. If you cheat your federal taxes and you're convicted of a tax crime, you'll go to jail for maybe a year or 3, but that's rare. What you should not do is fail to pay over your sales tax receipts in the state of Maryland or New Jersey or Illinois, because then you're looking at 6 years, and they do not have country club jails in those states. And when we chase people around for their taxes, like we had this to-do a few years ago, and it is sort of, things sort of waft and wane. We had a to-do a few years ago about a relative handful for our country, for the size of our country, of rich people who had accounts in tax havens, and they didn't tell the federal government about them because there's a little line on your Schedule B where you're supposed to tell the federal government. The federal government would very much like you to come in and tell us about your offshore account and pay us some fines, you know. But the federal government will not use the basic tools that your malpractice creditors or your wife's divorce lawyer will use to get you when you run off and lie about your foreign accounts. You know, there's gentle punishments and there's also gentle enforcement in our system. How am I doing on the time? Okay, so but I'm not going to take the whole half hour with this one. Okay, wait a minute, let's see. Yes, okay, all right. So that is really kind of a wholly unnecessary document when you get right down to it. We're moving to individual income taxes for a minute, and then we'll go to corporate income taxes. We don't need to, given that we do all this wage withholding, right? We over-withhold, and then people file returns, and they get a refund, and the refunds are enormous. But people like it that way. I actually asked somebody the other day who was wanting to redo the individual taxes, you know, if we want people to keep more of their paychecks, why don't we just stop over-withholding on them to the tune of $2,000 a year or $3,000? And he said, oh no, we tried that in the second Bush administration and people didn't like that. They want a little reward. Actually, it's a big reward now. It used to be smaller. They want a reward for filing this hunk of paper here. This is a piece of it, and this is not even a document most people file, okay? Most people file a little one-page thing or a two-page thing, a 1040EZ or a 1040A. It says, what did you earn? Copy that number off the W-2. Copy that other number that says what we withheld. Here's your $3,000 back. This is a Schedule A, and this goes to how we use the system for behavioral things and to subsidize certain behavior, because you see right up here, oh wow, I'm using the pointer on this. Okay, medical expenses, this is for your uninsured medical expenses. In, you know, pretty much everything that is significant in tax happened in World War II, you know, because of the Vietnam War or because of Reagan. Okay, this is World War II. If your employer spends thousands of dollars on medical insurance for you, it is not considered part of your compensation because the Treasury ruled that way back in the 40s when there was wage and price controls on. And that, when you think about it from an economic sort of standpoint, it might actually even be a barrier to getting to single payer, because people have gotten the idea that, well, of course, medical care is supposed to just be free, right? The fairies bring it, right? Then we have the state and local tax deductions right there. Those are basically blue state subsidies. We have mortgage interest right here. That's our housing policy right there on those lines on that return. Our housing policy is you will live in a dump unless you take title to your house, and in order to take title to your house, you should probably get a 30-year mortgage, which was an artificial creation to enable people to buy houses. And it's also the source of a lot of trouble because, let's see, I'm going to take this back. Well, it's also the source of a lot of trouble because of what happened in 2008. Let me take this. Where is this other one? Then further on down, we have business losses and business deductions and casualty losses, charitable deductions. All of these, this one, and this one, these are big subsidies in the individual income tax, the charitable one there. But you can see that very little of them, only really the medical expenses and the casualty losses and the business expenses, have anything to do with measuring what was your net income from your gross. So then when we move on to the corporate income tax these are very big numbers, okay? That's why in the tax reform, they're talking about cutting these things. And the reason they're talking about cutting these things in the tax reform is because we can't just, push money out to companies as a big rate cut, which is what they want, right? We have to do it within the budget rules that Justin was talking about down there. And in tax land, those CBO estimates of what something costs, in quotation marks, those are sacrosanct. Nobody even questions them, even when we know they're completely crazy. And they can be completely crazy in an upward direction or in a downward direction. Sometimes we do favors for banks in the tax code where we look at the number and we say, oh, is that a per bank number? That can't be the number. So when we get over to the corporate side, and they didn't put a corporate income tax return up here. When we get over to the corporate side, we see a very big subsidy component. The corporate income tax is really kind of a carrying mechanism, a subsidy delivery mechanism. It's 3 parts tax and 1 part subsidy. The tax brings in about $340 billion or so a year. So then when we're talking about the tax reform, and we're talking about, the numbers that are being bandied about by the administration and the group of 6, they're talking about a tax cut, mostly for companies, of $1.5 trillion over 10 years. That's $150 billion a year. In military terms, that's like nothing compared to what we spend there. But it's also just really, when you look at it relative to the corporate tax structure we have now, it's kind of just doubling the subsidy component of the corporate tax. And we say, well, why can't we just do that? Why do we have to pretend that somebody over here has to sacrifice something so companies can have lower rates? Because that's all this is about. It's about lower rates for companies. Among the subsidies they get that compose the current ones, there's a manufacturing deduction. It had to be done as a deduction because of the way it's booked. There's very generous depreciation. There's interest deductions. What was the other one? There was I'm forgetting at the moment there's depreciation. Oh, LIFO, which is mainly used by, I should go back to the first slide, oil companies, because oil company profits are always inventory profits. Those subsidies are so big, and the corporate income tax is got such a high subsidy component that in order to materially lower the rates, and the top rate is 35%, and they want to lower it to something, they want to lower it to 15 or something in the 20s, and they'll probably get it, higher than that. They'll probably get it like 29, 28. The subsidy component is so high that if you start saying, and these are the rules, there's 2 sets of budget rules. If you do a normal tax bill, which is not what we're talking about doing, but if you do a normal tax bill, if you cut taxes for somebody, or you give a subsidy through the tax system, you have to make it up somewhere else in the tax system. Somewhere else in the corporate tax, somewhere else in the individual tax. That's the normal rule, and that's the 60-vote rule. In the reconciliation rules, you can have a little more fun. You have a 10-year period where you have to stay within your budget instruction. Sometimes your budget instruction is to be neutral. Sometimes it says you can spend a little. And while you're within your budget instruction, you can fuzzy things around. You can say, oh, well, I'm cutting the corporate rate over here, but over here I'm cutting Medicare. We cut Medicare every year, folks. And it goes up every year because the numbers have nothing to do with reality. They just sort of specify, well, we'll pay less for this or that treatment, but as Justin will tell you, the numbers always go up, right? So, but here's the weird thing about these constraints, and I'm working my way over to Bill here, and that is, if we didn't have these constraints, and this is what I don't tell corporate audiences in quite so many terms, but I basically say to them, look, all these numbers are just made up. They can spend on you anything they want. But if they knew that the government could just spend anything they wanted, because $150 billion a year is not even the whole unaccounted for military spending. Okay, $150 billion a year is twice OCO, which is overseas continuing operations, which is a fancy word for bombing. Bombing costs $1 billion a week. It's nothing compared to that. If we can just create money and spend anything we want, and we told a bunch of large corporations that are hardly paying tax now, look, we can repeal the whole corporate income. That's what they would ask for. They would ask for more. They wouldn't say, oh well, we'll deal with a 15% rate. They would say, no, you're flatline. You're going down to zero. We don't want to pay any taxes whatsoever. You should be grateful to have us. You should be grateful we're still maintaining our headquarters in the United States. Because what they're gonna do in the Congress in the next few months is they're gonna turn themselves inside out. They're gonna wrestle with these numbers, day and night, literally. Justin will tell you that, and you might be looking at a 29% top corporate rate as compared to 35%, and the companies will look at it and they'll sniff and they'll say, well, that's not good enough. It's sort of like you bought the new dog food and your dog doesn't like it. That's what it will be. All right, so let us work our way over to banking regulation. What we have in banking is because we're so big, because we can absorb such complexity. I'm going to talk about Dodd-Frank. Bill is not. Dodd-Frank is the F-16 of bank regulation. It's just kind of too big and too expensive and too complex to do its job. Usually I talk about the F-16 for 20 minutes, but I won't do that here. But yeah, and the other thing about, let me finish up taxation here. The other thing about taxes is, what we should really be discussing, and Congress really likes to fool around with the taxes because it's something they can control. Because once they have ceded trade policy to the president in what's that called when you have free rein to negotiate the trade? What's that special instruction called? Fast track. Once they cede fast track to the president, they have no control over stuff. Nobody understood in 2002 that manufacturing would go to China wholesale. So and the reason I'm bringing that up is you can say, well, if we're subsidizing companies and they're not paying much tax anyway, why don't we talk about the subsidy part? Instead of talking about the tax part, why don't we subsidize them to do things we want them to do? Why don't we subsidize them to create manufacturing jobs in the United States? Because the manufacturing deduction that we've got in the law right now, it's a very big item. It does not require any jobs to be created in the United States. So you can say, why aren't we having that discussion? But even if we did, let's say we designed the perfect incentive to create jobs in the United States, the economic non-tax incentives to be in China are so huge that they're very hard to overcome. And I will turn it over to Bill for some bank regulation.
Right on time. This is the beastie. That's the beastie. So I have to get to my slides to kick them in.
Okay. So thank you all for coming. I'm Bill Black. My primary appointment's in economics here at UMKC. I have joint appointment in law. I'm a white-collar criminologist, a former financial regulator, and a serial whistleblower. All of which is actually relevant because this should be a presentation twice as long where I would have the second part, but you only get the first part. And the second part would be why modern macro desperately needs all of those fields that I've just talked about and excludes them. So this ADM God, this is not something I'm putting in words, stuffing them into them. This is what they are actually now putting in book form, is central to their models, which is an extraordinary thing. So I'll begin with Coach Lakota. I'm now spending half of my time in Minnesota, and Coach Lakota was the chair of the Minnesota Economics Department. The big claim to fame of the Minnesota Economics Department is that 3 scholars who got Nobels did much of their work, and it was on modern macro. So he then became the president of the Minneapolis Fed, and the Minneapolis Fed and the Department in Economics of Minnesota have had this incestuous relationship with cross postings and things like that. And then he did a semi-road to Damascus conversion and became a dove, albeit not anywhere near an MMT type person, and not renouncing in any way modern macro, but certainly saying, well, he made some very explicit, relatively plain English mea culpas and said, we have failed the nation repeatedly and our system doesn't much work. So notice the sly use of the word almost in that phrase, right? So almost coincidentally, in these dynamic stochastic general equilibrium models, which are the core of modern macro, all government interventions, including all forms of stabilization policy, are undesirable. Now, Coach Lakota, obviously, by putting the word almost in, realizes that this is not a coincidence in any way, that dogma drives these things very heavily, and I hope to show that. So I'm going to use largely Athrea's book. Now, Athrea is the research director at the Richmond Fed. His predecessor as research director of the Richmond Fed became the president of the Richmond Fed and had to resign recently in the scandal when he leaked the proprietary information to the press, which is not exactly what you're supposed to do as a Fed president, right? So this is Athrea in big ideas in macroeconomics, right? Modern macroeconomics is almost, but not perfectly, dystopian. It remains maximally cynical about the behavior of people and the corporations they run. It presumes that large firms are aware that they are large, will monopolize if they're allowed to, and will exploit policymakers' inability to commit to not bailing them out. It implies that people will employ any means they know of to avoid taxes, which would include bribery, murder, those little types of things. Now, Athrea says this is just, in the part of the introduction, this is what modern macro is. Indeed, he's not even talking about modern macro. He's talking about modern micro, allegedly, and new institutional economics. Now, this is news to a whole bunch of us, where we know that they never make these kinds of assumptions, so let's follow it through. Athrea certainly knows the concept of dystopian because in addition to writing about modern macro, he writes about credit, right? And this is from one of his academic articles, which he starts with this quotation, right? Can everyone read it? I won't stop reading them at this point because you can read it more easily. No, it's the voluminous in 2001. Baird's voluminous in 2001. Now that's dystopian, right? We've put you in jail for your debts, and you die, and that's how God wants it, right? And that's how we want it, that type of thing. Okay, but, the Hyde was writing some time ago. Things have changed a little, and that's part of what Athrea is upset about, because he wants to make things worse. But again, first we're talking about Williamson and Diamond. Diamond has said, hey, we claim that we, follow these standard assumptions of self-interest and rationality, and they could lead to really bad behavior, but in practice we exclude all of these things. And Williamson, in this context, is also going to get a Nobel Prize in New Institutional Economics and such, and is going to say, I'm going to bring opportunistic behavior truly into the model. Okay, back to Athrea. He didn't just quote Hyde. His big plea is this. Okay, so first he goes through in a footnote the forms of torture that used to be allowed. Right? You could not only throw them in jail and have them starve to death, but you could torture them along the way. And then he says, unfortunately, all movements in the modern era are away from this model towards more lenient systems. And so think of what a punishment harsh enough to guarantee that no one would ever fail to pay a debt, especially those of you who are in the student ranks and such. Perhaps thought of being sick every once in a life or losing your job. It's pretty amazing stuff, right? Well, economists historically have known dystopian. It's pretty damn dystopian, right? Nassau Senior, actually in the history biz, which of course they no longer teach in neoclassical, was a pretty big deal. Well, we always talk about voluntary transactions, and a number of us talk about the rule of law and how important it is. Well, underlying all of that is a pretty harsh reality in a number of cases, right? So if you were Irish and you were a peasant, and if you were an Irish Catholic, you were a peasant, this landlord, this voluntary stuff, right? Not so much. And the English were very clear with the advice of classical economists that it was critical to enforce the standard. They were appalled that anyone in Ireland might think that they should do something rather than have their kids starve to death when hundreds of thousands of them were kicked out by the landlords, sometimes in winter, often very sick and such. So we had to it's a sacred right. Living, not sacred right. Property, sacred right. Okay, Burke, of course, famously talked about the penal laws that set this environment in practice. And it really is, for the lawyers in the group, it is ingenious. The Brits came back over 150 years, time after time, improving these with new, novel ways of divesting the Irish from power. Okay, so now we go forward again with Athrea, and Athrea says, hey, we have finally figured out what's going wrong with our models. There are two things that are really causing us trouble, and they interact. So this first one is this asymmetric information stuff, and the second one is limited commitment. So asymmetric information is probably clear to everybody here. Limited commitment is jargon, and it brings back that old stuff on debt. Limited commitment means you may not actually repay the creditor, right? That's the problem with limited commitment that they're talking about. These are the two usual suspects in creating problems for decentralized trade, and that's jargon for essentially what they would call free markets, okay? So it says this is where we actually have problems in the world with things that we would like to call free markets. And just starting with asymmetric information, he This is his description. He describes these as spectacular pathologies. So these are not little problems. These are really big problems. Right? Plus, remember, those are just the problems that arise from asymmetric information. And he says, I'm going to convince you that that's actually not the big problem. The really big problem is limited commitment. It is the main form of sand in the gears. And if you're familiar with the concept of frictions, this is a really different use of friction. Right? Friction is usually physics envy and math sloth. You know, we don't want to do the complex stuff, and we just ignore friction. This is a use of friction where it actually causes the machine to break and collapse, right? So he's saying that this isn't just a minor impediment. This can actually bring down this system that they venerate. Well, that's a pretty big deal then, right? That's really where the work needs to be in modern macro. And worse yet, they interact. And when they interact, the things get much more complicated and they get much nastier. So we started with spectacular pathologies, and then we went to a system that wrecks the whole system, and now the friggin' things interact. Right? This is not good. And it gets worse. Pathologically riddled by dynamic consideration and feedback effects. And while he doesn't say it, feedback effects means the goddamn bank fails. And there's a liquidity crisis. And many institutions fail when the one institution fails. So, again, we're way past pathological into pretty frank, but not in plain English, admissions that the system's really screwed up. This is amazing stuff coming from modern finance types. But wait, what are they actually looking for? Now they know these are the problems, but what are they actually looking for? Something where inevitably the right thing happens if what? Self-interested smart. In other words, if the standard neoclassical assumptions are present, it will all go well. In other words, they're still searching for the Holy Grail, even though they know that it's failed. So we need something to... So there's 150 pages of bragging about modern macro, right? About how wonderful it is, how rigorous it is, yada, 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 yada. But this is kind of a weird way of phrasing it, right? This is back to the dystopian view, but it's a dystopian view of modern macroeconomists, that they would love to lie to us. And therefore we must force them not to lie to us. And the only way to force them not to lie to us is to have this rigorous mathematical program system, because it prevents any associated smooth talk. Right? Oh, but he's just winding up. Outside of the bounds of mathematics, they'd routinely be able to obfuscate, be ambiguous. The premises, the assumptions would not be known. Okay, unstated assumptions are among the most dangerous because sometimes you don't even know that you've made them. The reader certainly doesn't know that you've made them, and you are not forced to justify them. So this is where, again, it's the old line about it's not the things that you don't know that get you in trouble, it's the things that you supposedly know that just ain't true. But here's the good news. Modern economics makes it impossible to have this problem. They have fixed human flaws through mathematics. Now, this is a pretty tough test. And he says it's vital. Right? Many things could be associated. It's the old correlation stuff. Here he's saying, we have to really prove causality along this way. Okay, great. And we've got to do it with observable data, right? In fact, observed data. We need persuasion, and it's got to be internally consistent. So all the logic models have to be met as well, right? In sum, if, remember the if, there's one rule we play by. Now this, of course, reiterating Keynes in many ways, right? It takes a model to beat a model. And he specifically cites Akerlof, which would be the other 30 minutes of the presentation. And then he warns us. Remember, decentralization is free markets. Don't deify it. This is a subchapter heading, right? Don't do this. That's on page 7. On page 103, a silent assumption of the ADM model is that there is an ADM God. And it goes on for 3.5 pages about how there are silent assumptions that not only are there no problems, remember those spectacular pathologies? But that no one even thinks about doing anything wrong, and all the enforcement is absolutely perfect and absolutely costless. In other words, we're back to our standard assumptions of perfect information under which fraud can't occur. If you have perfect information, nobody can be defrauded. Except that, remember all those things that were wrecking the models and causing them to go wrong? They've all been assumed out of existence, and they've been assumed out of existence silently. It's a pretty extraordinary thing to admit. But, not to worry, we certainly shouldn't look anywhere else. Because, as economists, we know next to nothing about anything else. And therefore, we can't make judgments about anything else, unless, of course, it's, say, white-collar crime. Because he suspects that he's not being perpetually defrauded. If you've read the Romer critique, he hammers a usage similar to this, right? And notice the addition of the word perpetually. You don't need perpetually to get the problems that he identified. None of his analysis required perpetually. He stacked the deck. But of course, smooth talk is impossible. Oh, and there's another small exception to this scientific method. We don't do bubbles or windows, right? Because, why? Because he's pretty much admitting it here, right? Because it would discomfit our dogmas, right? We are unwilling. All that rational stuff, all that math and all that logical inquiry and consistency and what takes a model to beat a model, it's all disappeared. And this is kind of revealing, this is how they actually choose. Remember when he said earlier that we only say that we got it if it's the only possible explanation? Well, there's actually a footnote to that. Actually, we look for things that meet our assumption. All right? So one of these, of course, is, sure, firms are going to be profit maximizing. But remember that he told us that it takes a model to beat a model. If there's any rule they follow, that's the one. And that would be these guys named Akerlof and Romer in 1993, looting the economic underworld of bankruptcy for profit, in which they explain at considerable length why the CEOs would rationally make investments that they knew to have a net negative value. Because it would make a lot of money for them, not for the firm, and they would care more about themselves than the firm. Right? So you can see that the priors are controlling and are sneaking back in. Again, remember, he said he's going to follow, that guy Akerlof was right, he had the better model, we're going to follow him. So, when it comes to deposit insurance, first thing is it creates a principal agent problem. How? He doesn't say. Does it? No. Principal agent problem already existed, as anybody who knows anything about banking or law knows. Okay, but it says the real problem is depositors will fund activities irrespective of the ownership stake held by the present management. Now, does Ethrea want a management stake? Does he think that if their management owns substantial stock in the bank, that will reduce risk? That's what he's saying, right? Well, it just turns out to be exactly the opposite. And by the way, it's discussed in Akerlof and Romer in considerable length. And it's discussed in the National Commission to investigate the causes. And it's shown over and over again in the prosecutions. But it was exactly the opposite. When the CEO held a substantial chunk of the shares, he was able to dominate the firm more, and it made a better fraud vehicle. So, savings and loan debacle, really easy. Gambling for resurrection. Sorry? Except, Akerlof and Romer said, no, that's not what was going on. This is their concluding paragraph for emphasis. This would be the kickoff to the second half of the talk I will not give given time. And that is, these fraud mechanisms can become large enough that they have macroeconomic effects. And they can certainly be large enough even when they don't have overall macroeconomic effects in an economy the size of the United States to blow the hell out of a deposit insurance fund and fundamentally transform a market. So Akerlof and Romer say, no, this is a problem of looting. This is a problem of intentional fraud. And that the regulators got that right. There is the little matter of public matter of over 1,000 felony convictions. There is the National Commission to investigate the causes of the crisis that said that fraud was invariably present at the typical large firm. So one could have a different view, and indeed, Akerlof and Romer went on and said, why would you gamble? Why would you not take the sure thing of fraud? And they said, if your theory is that they were engaged in honest gambles, how do you explain the fact that their behavior would have been completely irrational if it were an honest gamble? That they didn't do the simplest things that would be essential to increase the probability of success of their gamble. And Black is still forcefully making those arguments in front of you. Okay, so I assume time-wise we're...
We got a few more minutes.
Okay, well, the key concept I would like to get across from the next half hour of the presentation that won't occur is when you get not simply episodic frauds, but large numbers of these frauds. Large enough that if they continue for years, they can, again, have true macroeconomic effects. And the first concept is a criminogenic environment. That should be really congenial to anybody from neoclassical economics. It simply says this is an environment where there are perverse incentives to engage in fraud. And Akerlof and Romer talk about this. They talk about how the deregulation was bound to create it. They talk about the weak accounting rules. They talk about the weak capital standards. They talk about the deliberate evisceration, not just of regulation, but of supervision and such. And we have a whole literature in regulation and criminology about this as well. But a leading example of it, and one that was critically important to all three of the major crises, so this is the savings and loan debacle, the Enron era frauds, and the most recent crisis, but it's also something that could potentially allow us to find allies elsewhere, is this concept of a Gresham's dynamic. It was first labeled this in George Akerlof's 1970 paper that led to the Nobel Prize, the one on lemon markets, right? But here's, again, the key point is it isn't just the customer, the more obvious victim, it's the legitimate competitors. Because if you gain a competitive advantage by cheating, then markets become perverse, and they will tend to drive ethical folks to failure, right? So this is something that we can say, look, and people like me, in fact, are not hostile to business. We want honest businesses to succeed, right? And we very much can only do that if we do these things. So a whole series of Gresham's dynamics were deliberately created in the savings and loan debacle, in Enron, and most pervasively in the current crisis, or the most recent crisis. This resulted in 3 epidemics of control fraud, 2 in the loan origination process, one involving liar's loans, the other appraisal fraud. They're not mutually exclusive. You can do both at the same time, and it was common to do both at the same time. But virtually all the emphasis, I would guess even in this group, has been on secondary market. And the theory usually is that there was no skin in the game once you sold to the secondary market. But in fact, virtually all sales to the secondary market were under reps and warranties. And more precisely, they were under reps and warranties that were fraudulent. And that's why you see these very large settlements eventually. Right? It's solely, well, it's overwhelmingly under a rep and warranty theory. So the theory that there was no skin in the game is incorrect. The first 2 fraud mechanisms are actually more important because once they occur, there ain't no fraud exorcist. The only way you can sell them to the secondary market is going to be through further fraud in the form of reps and warranties. That's going to reallocate the losses, and that can be bad because it can concentrate them in particularly vulnerable institutions and such. It's a matter of importance, but the first 2 ones are the ones you really want to particularly concentrate on. And I'll just leave you with the ingredients and the 3 sure things that result from it, because you will see this again, any of you who are younger. Notice that this worked not just for the lender, but also for the purchaser of the loans in the secondary market, and it could work simultaneously for both. Again, the emphasis, we're not talking about the firm, we're talking about the officers that control the firm, whether they could be made wealthy. 1, grow massively. 2, by making or buying in the secondary market truly toxic loans, but with high nominal yield. Okay? 3, with extreme leverage. 4, setting aside only trivial loss reserves. The tell, I will leave you in the sense of poker use of the word, is that you have to gut your underwriting system. And that is unambiguously bad for the world. So whether or not you're right about fraud, if you see really crappy underwriting, you should immediately, as a regulator, fix it. You aren't going to do any harm to the world in terms of type 1, type 2 error. Liar's loans by 2006 are 40% of all the loans made that year. Half of the loans called subprime were also liar's loans. They're not mutually exclusive. Liar's loans grew by more than 500% between 03 and 06. According to the industry's own anti-fraud experts, the incidence of fraud in them was 90%. That means by 2006, well over 2 million a year are being pumped out, and they're ending up in CDOs. Appraisal fraud, in this incredible petition I urge you to look at, that'll tell you about it. Here are the three sure things that result. And these are mathematically guaranteed. Now, how long they'll last isn't guaranteed. And the more firms that follow the same strategy, the more likely it is that the bubble will hyperinflate and that you can refinance the loans and keep the fraud scheme going longer. But the bank will report record income, and it will do so typically immediately, like 1 quarter after. The CEO will promptly be made very wealthy, and down the road, the bank will suffer catastrophic losses. If a bunch of folks follow the same strategy, it's a really good way of hyperinflating the bubble. Thank you very much.
Right on time. You want to take a few minutes first? So we're going to pass it off to, as always, whenever you say, we have less presenters, so we have even more time, we quickly can easily burn through that. So do you maybe 5 minutes? Yeah.
Thank you, by the way, for having me. I'm very happy to be here, and I'm thrilled to be here with Bill Black because it's always. I'm not on my mic. It's not a real mic. Okay, so thank you for having me, and I'm very happy to be here with Bill Black too, because he's a lot of fun. Now let's pick up on that and go into Dodd-Frank. Remember Jamie Dimon before Congress basically saying, "Look, we're going to take this thing to the wall every few years, and you'll have to bail us out." And his lifestyle and none of the lifestyles of anybody else will suffer. And that's a monetary theory illustration right there, because we spent $13 trillion bailing out the banks. $3 trillion of that was financial repression. Going to ZIRP, that costs savers $300 billion a year. Fed took $5 billion onto its balance sheet. About $1 billion of that was actually appropriated by Congress, and it was appropriated to purchase mortgage-backed securities at their market value, but Hank Paulson took it and just pushed it into the banks instead of, he could have bought the shares of the banks on the market for less. And then you're left with the difference, which is got to be something like 2, 3, 4 trillion, which the Fed also spent. There was a whole bunch of programs. One of them was Cash for Trash, but they all have cute little acronyms. Buying garbage off of people's books and probably overpaying for it. So what that tells you is, just because we know that, Congress or the Fed can create money anytime they want to do anything they want, doesn't mean they'll use it for good. It doesn't mean they'll use it to say, well, we don't really have a deficit in Social Security. They could use it for things like propping up, garbage assets like this. And Dodd-Frank, and this I will not go into detail, was a gigantic missed opportunity. It was truly a crisis gone to waste. And in order to get better bank regulation, we're going to have to go to the wall again, which we're about to do because we've got derivatives exposure exceeding what we had in 2008. The main thing Dodd-Frank did, and I misspoke about my planes, the F-16 is a 40-year-old warhorse that works. The F-35 is it's a computer, basically, with wings on it. It does not fly. It keeps failing basic tests for things like taking off from an aircraft carrier and things that it's supposed to do. But the program will live on. Oxygen. What do they need oxygen for? They have a $500,000 helmet on their heads that weighs too much and that they can't see out of. What do they need oxygen for? But yeah, the main thing that Dodd-Frank did was it strengthened our capital requirements. At the time, our capital requirements were the strongest in the world because we were the only ones that had a leverage ratio. The reason the European banks are just reeling right now is
the FDIC.
Yeah, they've never seen a leverage ratio before. What? You mean we have to all the assets and all the No, all of them, all on both sides? No. But yeah, we strengthened the capital requirements, but when you hit a crisis or a liquidity crunch or whatever euphemism you want to use, you can burn through capital pretty fast. So capital requirements alone aren't going to do it. The main missed opportunity was we decided that we were going to take all the things the banks were doing that were dangerous and make them safer. And some of these things are just inherently unsafe. You know, credit default swaps are inherently unsafe. And we didn't say, don't do them. We said, oh, well, try and get some margin for them. And then we took ordinary swaps, which people were already in the process of clearing, and we said, oh, have a big clearinghouse. And a big clearinghouse, by the way, is another undercapitalized, too big to fail entity. And then what the Trump people are about to do, the watering down of Dodd-Frank that the Trump people want to do, you have to understand that Dodd-Frank is a very complicated thing that just nibbles at the margins of everything except the capital requirements. The now regulations that came out during the Obama administration that interpreted it watered it down. And so what the Trump administration is now proposing is further watering down. But you're not dealing with a product that's that great in the first place. One of the things they want to do is remove cleared swaps from the leverage ratio measurement. And well, let's see, what else do we have? The thing that folks in this room need to worry about, but maybe not as much as they think, is the consumer board. And the reason is, Wells Fargo basically gave Congress a gift, by creating all those accounts for people, because, you can just trot that out and say we still need this agency. They did lose a court case. They do have to redesign it, but it will continue to exist. On the Volcker rule, the administration wants to water that down too. But these folks got rid of all their traders, and the big banks, and they don't really want them back because they've discovered in the meantime what a burden they are. And they are a burden because when you have them, all the income they produce, you'd like to have that on your balance sheet and make everything look all pretty, but they eat so much of that it's hardly worth having them around. And so what else do I have to say here? Yeah, that's about it. Thank you very much.
So I'm going to take moderator's prerogative for a little bit and make myself even more of a liar, but not a fraudster, in terms of asking my own questions before I open it up to the audience. One thing I wanted to start a little half comment, half question for Bill is, what's interesting about the limited enforcement discussion from the beginning is he sort of applies that, or limited commitment. That discussion is, he's sort of implicitly discussing that with economists. He's arguing that there's limited commitment for economists to, saying anything that's important if they're not using mathematics. And so mathematics is kind of the collateral they put up to be taken seriously from other people. And so the flip side of that is DSG mathematics the debtor's prison of economists?
So the other thing that may be useful to know is that Athrea had his 15 minutes of fame about 4 or 5 years ago when he wrote a blog that said nobody who doesn't have who hasn't passed the grad macro sequence and the comps from a decent university should be allowed to write anything about macro. So and by the way, his father is an academic mathematician. So he feels obviously that these are real good reasons why maths should be critical. The substantive point is really the one Paul was making 2 days ago. The key thing that causes crises is when you get liquidity crises. And liquidity crises are typically generated by failure to pay. So a credit event. And am I pronouncing it? Is it Buiter? B-U-I-T-E-R? Buiter has just flayed modern macro even more than Romer. And his key point was, Modern macro not only doesn't provide any answers to the critical questions of liquidity and failures of institutions and credit events, it does not allow you to ask the question, right? And now you can see why. That while they say this is the most important thing in the world for our field and the most important thing for the real world, we actually assume it out of existence because it not sort of because it screws our model, but really more because it screws our ideology.
All right, I'll pass it off to Paul.
I got several questions. One is,
Can you wait till
well, the math is an easy question. When long-term capital management failed, and remember Shoals was a major investor in it, why did anybody believe that the Black-Scholes model, mathematically how great it was, had anything to do, because here was Shoals taking a failure on his own model. So I can't understand why economists or financial people, and I'm a member of PRIMA, by the way, which is the Professional Risk Management International Association. It's a funny story, but the question I want to ask Bill was fraud. Standard & Poor's gave these toxic assets AAA ratings. Was that fraud or just misleading advertisement?
Okay, so actually,
And the second thing is, whoever created the board, did they go to jail? Does anybody go?
well, all of us can answer that question.
No, all together now.
Okay, so here's the key document from S&P. Well, actually, it's the first of the two. This is Moody's. It was a slippery slope. What happened in 04 and 05 with respect to subordinated tranches is our competition, Fitch and S&P, went nuts. Everything was investment grade. We lost 50% of our coverage, our business share. So he's saying Gresham's dynamic. Now, this is just the subordinated tranches, and they're tiny. That's not where the real money is. So there's an even better one yes. So this will tell you everything about the credit rating agencies, plus one fact I'll add. The context. The boss has told the professional to go rate, right? Come up with a rating. And the poor professional has said, okay, give me a sample of the loans so that I can do a credit rating. You know, like we're like a credit rating agency. He gets back the following flamegram with all caps and, you know, the 5 exclamation points type of thing from his boss. Any request for loan level tapes is totally unreasonable. Most investors don't have it. Now, that means that the Merrill Lynch, the one creating it, never got the loan tapes. In other words, it never did any due diligence itself on the loans.
Because it was going to pass them off.
Well, no, because it knew that S&P would never look at the loan tape. So why would you pay? Because you would just be establishing your question, the fraud case. If you look, what do you have to do?
Report.
You have a 90% fraud incidence in 40% of the portfolio. So even with the tiniest sample size, you're going to have to report that you knew that you were selling crap and giving it a AAA. That would create a great fraud case. So it's far better to have the financial version of don't ask, no tell. So here's the conclusion. We must, capitals, produce a credit estimate. It is your responsibility, professional, to provide those credit estimates and your responsibility to devise some method for doing so. So we know exactly how many loan files were reviewed by the big three in giving the ratings. And what do you think the typical sample size was?
2%.
No, I just told you it was 0. That was a gimme. So Fitch did a study after the secondary market collapsed and there were no more fees to be jeopardized. And that study, if I could hold just a second, I'll get the exact language. The result of the Fitch loan file analysis was disconcerting, as there was the appearance of fraud or misrepresentation in almost every file. The files indicated that fraud was not only present, but in most cases could have been identified with adequate underwriting prior to the loan funding. Well, that would be disconcerting since you just give a AAA to all of this crap.
Well, but there, I forget who wrote the book about liar loans, but he had emails of these guys that put these together and say, I've just sold this crap to so-and-so. I mean, they were calling it crap when they were selling it. So somebody knew it was crap.
Because hedge
When
funds.
did they go to jail?
Well, they
Because you need prosecutors and you
Yeah.
need regulators to make criminal referrals, and we made over 30,000 criminal referrals, for example, in the savings and loan debacle. In the current crisis, it appears two agencies have answered and have said that either did 0 or 3 criminal referrals, and the FDIC was smart enough to refuse to answer the question. So it appears that they literally eliminated all criminal referrals. The Justice Department does not come without the criminal referrals. And institutions don't make criminal referrals against their own CEOs.
But the Justice Department must have read.
All right, I'm going to take some moderators.
The Department must have read this book, which has the documentation of these emails that said, I sold this crap to so-and-so. So why not go for the guy who sold the crap?
Okay,
Yeah.
so again, I'm a co-founder of Bank Whistleblowers United. 2 of my co-founders are the senior whistleblowers at Citigroup and Countrywide. These people went to the Justice Department and gave them chapter and verse from inside the institution about the frauds, including ones that were incredibly well documented and absolutely no prosecution.
All right, so we're going to do this quick. I haven't implement my moderators regulatory enforcement, and we're going to go Eve Smith, James Galbraith, and Rowan Gray.
The story about the rating agencies is bad, but it's a little more complicated because the decline in them, it's ironic that, of course, the Moody's guy was the first guy to testify in the FCIC, because historically the rating, and it proves your Gresham's law thing, but then there's some other things that require a little clarification. The worst is I should remember the name of the CEO, and I can't. But the rating agencies used to be guilds. It used to be places where basically people who were academic but didn't quite have the chops to become a professor, but were academically inclined, could go make a very nice living, comfortable living, working 9 to 5. And they were very sort of rigorous about what they did. And the person who wrecked that industry was the head of Moody's. And I don't remember his name, but he came into Moody's. He's the one who got them into structured credit, which is all this, the mortgage-backed securities and the other instruments, pushed the growth aggressively by being very friendly in how he modeled them. And he was famous in the industry for how terrifying he was. He literally people would not use his name. He has like a Lord Voldemort status, because he would walk into people's office and use the word "fired" in a sentence more than anybody was conceivable. He had a reign of terror at Moody's, and then the other rating agencies had to the Gresham's dynamic. They had to compete with him in the business. So then he gets up and makes these excuses, and claims that we were the good actors is just sort of nonsense. But the other issue is what really went to garbage in the crisis was the CDOs, and not the AAA tranches of even the bad RMBS. The AAA tranches, almost none of them defaulted. It was the lower rated tranches that went bad. Those went almost entirely into CDOs, and the CDOs were a Ponzi scheme. And the rating agencies gave those AAAs, and those were the ones, when they failed, they went bad top to bottom, because
The average downgrade was 25.
yeah, no. See, the CDOs at the worst point in the crisis, you couldn't repo them. They went to nothing, and those were what wound up disproportionately on. AIG was exposed to them. The monolines were exposed to them. They wound up on Citibank had $40 billion. They lied and said didn't exist. Suddenly one day they woke up and they said, "Oh, we didn't tell anybody last quarter we had $40 billion of this stuff," and the Euro banks, for different reasons, wound up with a lot of them too.
Now, James Galbraith.
Yeah, just very briefly on this question of criminal referrals, I believe this is accurate that the Financial Crisis Inquiry Commission did make one criminal referral of some note, and that was based on his testimony. It was of Robert Rubin. The Justice Department sat on it for 5 years, and when the statute of limitations had expired, the fact that it had been made became public.
Yeah, there were roughly a dozen criminal referrals by the Financial Crisis Inquiry Commission. That was by far the most prominent. It was based on my co-founder, who is the one who wrote the letter to Rubin, putting him on notice about these things. And as Rubin testified, we dealt with it adequately, which meant that they, of course, fired the whistleblower.
All right. So last but not least, President of Modern Money Network.
Hi, thanks. Love both talks, obviously. And Lee, your point about what happens when corporations know there's even more money in the banana stand, to sort of grift and take. Yeah, or if they did, I'm saying if they knew this. It's well taken that that's a risk, but it seems to me that, as you point out, the military budget's already a black box, and it's not like the banks don't get bailed out. It's not like General Motors doesn't get bailed out. It's not like we don't have all of these subsidies anyway. It seems like the only people right now that are not benefiting from this knowledge are the people, and that if this is going to continue to be a game where only the smart people know how the rules really work, then the guys with the money are always going to be able to pay someone to teach them. So it seems, I totally get your point, and this is something we definitely should be really concerned about. But I think the alternative is an uneducated populace, and that's going to be even worse. So I just thought you wanted to see if you...
I don't think that people look. I take that lecture there with the map and everything. Talk about the reserve currency to tax lawyers who deal with other people's money all day long. Okay, and these are ridiculously overeducated people. Okay, and I can't pound.
Intellectuals of the profession, too.
Well, tax law is harder than some of the other stuff. You've seen your lightweight lawyers around, and I can now. It's because they're so enmeshed in other people's money, and because this tax money is real money to the clients. Most of them don't have their own currencies, right? I can't. It's like pulling teeth, getting them to understand that the government creates money or that the banks create money. So if I was trying to talk to regular people, I wouldn't talk to them really about money creation. I would just say, look, you can demand Social Security, not be whacked, or you can demand single-payer medical care, and the government has got the money to pay for it. And it's a lie to say that they don't. And you can argue for. I think people should be making bigger arguments for cuts in military spending instead of running around arguing that corporations should pay more taxes. I mean, we have this corporate tax for fairness. I forgot to say that. We don't have it for revenue at all. It's really fairness. And it looks a lot better if they pay to regular folks, because the tax system exists not just to convince regular folks with wage withholding that the tax system is fair. It exists. It also is trying to telegraph to them that the whole economic system that they live under is fair. Now, we know it isn't, but we have to create the illusion of fairness. Everybody contributes, that kind of thing. So yeah, you have to have the corporate income tax, but mechanically, do you need it? Nah. It's not that much of the revenues. But yeah, people say. I mean, you saw the time that Mitt Romney told the folks in Iowa he was doing an appearance. The corporations were people, right? Because they were asking for whatever, and he says, "Where are we going to get the money for that?" And they said, almost in unison, and corporations should pay more taxes. And there he is up there in his white shirt and his dad jeans and his black shoes. It was such a great outfit. It's like, no, you have to wear jeans. Take your suit off, sir. And he says, oh, corporations are people, blah, 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 which did not wash with them. But, coming at it, having people come at it from a a situation of, oh, we have to collect more taxes when we don't tax for revenue and we barely collect taxes as it is not really the right way to come at it. You might as well just name your program and ask directly for it and then say, see my economist over here for why.
Thank you, everyone. Great panel. And next year, multiple on corporate power and possibly antitrust rather than just one.